Hello, Mark Sturdy here with another summary of our work this week, 7 days ahead, and looking at the major markets. You'll see that we remain bears of the yen, bulls of the dollar, and we think that's working ahead, working nicely for us. The dollar has strengthened, obviously, over the last 60 days, and so we are looking for. Whereas we were bearish of the dollar, now the strength of the dollar is throwing that into some sort of confusion, which we have not got involved in yet. It's a confused picture, but we would point out that there is, because of the strength of the dollar, the sterling euro has arrived at a very interesting juncture, which is a potential head and shoulders reversal here. So we need watch carefully for a close above 116 in the sterling euro. That will send the sterling a lot higher, notwithstanding the fact there's a big trading range. This is quite a powerful weekly pattern within it, and there's the daily pattern as well. That suggests it's right on. So watch sterling euro very closely, I suggest. Nothing much else to report, except maybe to point out dollar sterling. Such is the strength of the dollar, bringing the sterling down here. Look at, first of all, the monthly key reversal, which is a negative signal. The double failure at 137.88, a negative signal. The creation of a bear continuation rising wedge, which a break of 130 would be the completion of that. So watch closely, I suggest, for a break of 130 there. And that would be something quite exciting in cable. Moving on to stocks. We are not involved. We think the markets are under pressure, drifting, but far from major levels which might suggest a breakdown. Long, medium, that's the level in the medium term that has to break bull trends. So there is a drift, but it's nowhere near the medium term support that needs to be tested and broken if we were to get even the slightest bit bearish. It is worth pointing out that the least affected has been the S&P 500. These have been sold off harder, obviously. They have touched major levels. This high from 55.24 from 2000 is very important. This should be closely watched. A break of that would be important, very important, but it hasn't happened yet. Similarly with the Nikkei. This is in fact, the Nikkei is closest to testing a level of some importance, 52,500. Were that to break, here's the day chart, that would be poor. So watch carefully for that, and that is the closest level to watch in stocks. Bonds. Like the US equities, this has been relatively slightly affected. There's the big trading range in bond yields. There's the wide trading. We're right in the middle of that trading range of yields for the last few years. Note, however, the rise in yields over the last 60 days. That's pretty important. Actually, since that's over the last 2 weeks. Were 111.20 to break, that would be important too. More exciting, though, than what's going on in the US is the Germans. These have been much more affected. You'll see that the weekly yield has broken up through prior highs over the last few years. We think this is an important break, and that's why we're bearish of German bonds, bullish of German yields. This is a very important 299, 294 is as a range is important, where these two prior highs were. Look more closely. We're right in price terms, 25.90. That it closed just on it, just beneath it. On Friday, we are around. Look for a close beneath and second close beneath 125.90 if you're at all anxious about selling the German bond. We think it's bearish in any event because of the yield charts. Gilts are not dissimilar. We have had this long-term bear chart, this triangle in gilt yields. The market's gone sideways for a long time underneath that triangle. It looks as if we might have a breakdown now. The first close beneath 89.23. In yield terms, there's a little more ambiguity going on here. We would like a break above 492 bluntly in yield terms, or above this rising triangle's diagonal up here, which is 5.19 or something. There's a little more, but price-wise, we've already broken down, I think. Yield-wise, isn't quite as clear as the German Bund. We'd want to break above 4.9. Quite close though. Oil, well, it's heading up towards the top of the range, which is 105, broadly speaking. It's accelerating. Here's the daily closes. Forget the trading range there. Look at the daily closes. The price hike is accelerating. It's a wild, volatile market, but it is an accelerating bull trend, obviously. Gold, equally accelerating, but, however, there may be signs of stability. The trading ranges here are going, this is going sideways. Note the possibility, we're not powerfully sold on this, but there's a reasoning to suggest this is maybe a continuation head and shoulders, a bear head and shoulders, sending the market on down. This could have been a wedge here. This close here beneath these two prior lows could be a breakdown. So there's a certain amount of bearishness creeping in there. Something to watch. Thanks very much.